we see the secular shift of manufacturing back to the US as being incredibly strong. We think we're at the time of the intersection of a number of technologies that really are maturing. And it's not just the maturation of these technologies, but the intersection between them.
Welcome to Manufacturing Insiders. Today I have John Frankel. He is the expert in venture capital. Today is really going to be focused around those early stage founders who are looking to really scale and grow their companies. John predominantly works with companies in the AI tech automation space, and he's had billions of dollars of success in helping companies grow. And a very impressive track record, a lot of really impressive boards he's been a part of. So I'm interested to kind of learn some more about that. If you're interested in this type of content and you want to learn more, we cover a lot of topics of Manufacturing Insiders. Please drop a like on this video, subscribe to our channel, and you'll see more of us. So I appreciate that. Thanks for joining today, John.
Well, thank you for having me on your podcast.
Absolutely. So let's start with helping the average guy, somebody who doesn't know too much about it. What is venture capital, and what's the difference between venture capital and private equity, and maybe some of the other funding mechanisms out there?
Okay, so I apologize for making this simple, but I will try and I will try and do it without insulting people if I can. You can invest in anything,
Yeah.
right? And there's public markets and private markets. In the public markets, you have debt, equity, derivatives, and the like. And in the private markets, you have debt, equity, and derivatives, and the like. Within the equity space, or private equity with capital P, capital E, when people refer to private equity, is the vast majority of the capital. And private equity firms run funds, like venture capitalists run funds, and they invest through those funds into relatively slow growth businesses, generally with cash flows that have some heft.
Okay.
So they're later cycle investors. Venture capital are earlier cycle investors, and they want higher growth companies because if you're starting on a smaller base, you want to get to heft.
Right.
And so as a venture capitalist, we run venture capital funds. There are different sizes of venture capital funds. The larger the fund, generally, the later the stage it is.
I see.
We tend to be early stage.
Okay.
So we'll invest when there's 3 or 4 people, when someone's just getting going, maybe pre-revenue, maybe post some revenue. And that's the earliest stage. So we might invest at a $5-10 million valuation.
Okay.
Later stage firms could invest once the company's got some heft, 3, 4, 500 people, and it could be $1 billion or $5 billion or even higher when they invest.
I see.
And that's a different business. By the time you've got lots of people, you know the business model, you've got product market fit, you just need capital to grow, and it's a spreadsheet operation.
Right.
For us, it's not really that quantified, it's much more qualified. It's, do we think the team can do it? Do we think they have domain expertise? Do we think they have the skills necessary? Do we think there's a business there? And the business may not be there today, but do we think it'll be there in 5 years? And do we think the addressable market is large enough that this business can get to being 100 million revenue run rate? So that's what we look for. And by the way, not every business that gets started needs to be or should be a venture capital backed business. A local card trading shop or dry cleaner or restaurant is really generally not a venture capital business.
Right.
We tend to focus on businesses that have low capital intensity, that have high margins, and are not capital intensive.
I see.
I think I said capital intensive twice.
No, that makes sense. So that's kind of where the tech concept comes into. We're not talking about necessarily a manufacturing operation where you have to buy $5 million worth of equipment to get off the ground. So when you look at let's talk about a company in the automation space, because we've hosted a number of different guests in that space that are creating various automations and robotics solutions that would range anywhere from mobile EV charging to creating enormous lattice structures that can be used in aerospace. So when you look at these types of companies, there's a lot of them out there because this is the hot topic today. How do you're going to see domain expertise with all these guys. You're going to see a lot of possibility, a lot of application of their product in the market. How do you really look at them and know that this is a company you want to be involved with?
Well, I think us, like any other VC, has a thematic backdrop that we look for. So our seventh fund, we've been around since 2008, and we're raising our seventh fund. It's focused on the rejuvenation of the US energy and manufacturing sectors. So that's its focus.
Mm-hmm.
If you're doing something outside of that, don't come to us. Likewise, if you see a VC that invests in consumer brands, unless you're launching a startup in consumer brands, don't go to them. So firstly, play a little bit of matching.
Mm-hmm.
Secondly, look and see if there's anything that's directly competitive. We don't want to back direct competitors. You probably don't want to have an investor and give them information about your business if they also are investing in a direct competitor. So those are two basic screens to run.
I see.
For us, within manufacturing, we see the secular shift of manufacturing back to the US as being incredibly strong. We think we're at the time of the intersection of a number of technologies that really are maturing. And it's not just the maturation of these technologies, but the intersection between them. Things like 3D printing,
Mm-hmm.
which has been very tough to invest in over the last 15 years. There have been some winners, but not standouts.
Right.
But I think now, with manufacturing coming back to the US, it's reaching a really interesting point.
Yep.
The application of AI into businesses, clearly, what we're seeing with the latest wave of AI can really improve operational efficiencies. And we think that's important, both on the software side and on the hardware side. Believe it or not, the maturation of a smartphone has really enabled miniaturization of a lot of the pieces necessary for robotics. So we think robotics, drones, and the like are a natural outgrowth of the investment in smartphones that kicked off approaching 20 years ago.
Mm-hmm.
And
That's
then,
really interesting. Can I pause you there? Because
yes,
I want to learn more about that. And kind of where my mind went when you were saying that was I spoke with a really interesting guest a few weeks ago that they're improving workplace safety with AI. And basically, you can take a video of an employee moving an object from location A to B, and it's showing you kind of a wireframe of their body in red, green, yellow to determine where. And so they can actually do this from a smartphone. So you're removing the barrier to entry for really anybody to be able to analyze these workplace situations. Is that kind of the thing that you were?
So definitely on the software side, and the AI embedded in video and digitalization of video has enabled that enormously. But no, I was actually thinking, prior to smartphone, gyroscopes were pretty big, accelerometers were pretty big,
Mm-hmm.
right? Processing was pretty expensive.
Yep.
The acceleration of smartphones and the investment in all of the things that are necessary for the cameras, for GPS and the like, really has crushed the cost, the size, and the weight of these sensors, so that you can now put multiples of them, within robotics or drones at very accessible costs, at weights that make sense, etc. The advances in battery technology have really enabled the shrinking of batteries, the density of power.
Yep. Yep.
And all of those things feed in on themselves. And as those curves come down on the price, weight, function point, whatever the particular metrics are for that piece of technology, you open up new markets, and the intersections of them are fascinating. And so the idea of having a robot in the workplace that has, I don't know how many chips in it, how many processors, how many sensors, its ability to process the environment in almost real time,
Right.
is very enabling.
Right. Right. So you're,
And we're at the forefront of some of these sciences. There's a debate going on right now in self-driving cars as to whether having LiDAR and radar is additive to the process or takes away from the process. Tesla's on one side and says only cameras. And others have included LiDAR and radar and claim that the extra data helps them.
mm-hmm.
And there's a debate around this, and it's a fascinating debate, and it's at the edge of science. But we're continuing to see Tesla's self-drive capabilities outperform others that have all those other sensors. And also, Tesla's solution is about quarter the price because it doesn't have all of the expensive
Right.
equipment embedded in it. And the lower the price, the larger the addressable market. So watching, Cybercab, which at the moment have safety drivers, versus Waymo, which used to have safety drivers and doesn't anymore,
Mm-hmm.
how that can grow is fascinating, because if Elon Musk is right and cameras can perform as well, and his claim better than mixed sensor environments, the ability for cybercabs to grow at a very fast pace, much faster than Waymo can, and much less capital intensity, is fascinating. I don't know the answer, but I think it's these kinds of things that will be enabling and will spill over into other technologies. We're used to the idea of the space race and technology that spilled over it into things that people didn't think, like Teflon plans and
Right.
pens that can write upside down, all that kind of stuff.
Yep.
In the same way, every technology advancement spins the stuff off. But whereas back in the 50s, technology was, I don't know, and I'm going to pick a number, 5% of the economy. Today it's 75%. So there's much more opportunity and intersection.
Right. So the model with Tesla, from what I understood from what you said, they're leveraging the cameras and then using AI to interpret what's being recorded, versus having more of a traditional LiDAR, radar sensing these things in the environment.
So to be clear, they're all using AI.
Yeah.
They're all using fast chips. Tesla says you can do it only with cameras. Waymo has cameras and LiDAR and radar.
Yep.
Tesla's going to produce cybercabs, they believe, at the $40,000 price point. Zip code, it may be 30. I can't remember the exact number they've put out there. Waymo is closer to 160.
Wow. Yeah.
So these are zip codes. So think of the capital intensity. I think Waymo wants to add 5,000 cars next year. Once Tesla proves itself out, he can manufacture a couple 100,000 cars if he wants, because he's got the factories to do it.
Right.
So I think this is a fascinating example of different approaches that are taken. When you look at space, NASA full of rocket scientists, literally, and this geeky on the spectrum technologist comes along and says, I think I can do it for 1/10, 100th, 1,000th the cost of getting to space, and everyone laughed.
Yep.
And then he succeeded, and now,
he's catching rockets,
catching these things out of space.
Yep.
Is just
It's the
you know,
out of the
it's
box thinking.
it,
Yeah.
and that's what we think will happen.
Yeah.
So we think in both manufacturing and energy, there will be an unleashing of orthogonal thinkers.
Mm-hmm.
People who say, if we're bringing it back, let's not just copy the processes in Asia and drop them in here. Let's think of new ways and new products, etc. Take advantage of producing locally, of mass customization. This is why I think 3D printing is fascinating.
Mm-hmm.
And I'll give you an example if you want of that. And doing it a little differently. And
Right.
we think there will be, so the massive problem you're solving is we export all of our expertise and supply chains overseas. And how do you bring them back? I mean, it doesn't happen overnight. It's going to take 10, 20 years. But how do you bring the whole supply? And I actually believe there'll be hundreds of thousands of entrepreneurs attacking different pieces,
Mm-hmm.
and it will all come together. And the new supply chains will be sleeker and more efficient and thought about from first principles in the same way that SpaceX thought about going to space differently as well.
Right. Yeah. I mean, as long as there is some continuity in the overall goal, and that's the biggest flaw in the American political system, is that every 4 years or every 8 years you have somebody else come in with a totally different philosophy on how things should be done.
So on these principles, firstly, there are secular themes independent of administration. We, on the energy side, the demand for energy here way outstrips supply. We have to fix that problem. We're on a manufacturing podcast, so let's talk about that. On the manufacturing side, I think it's just going to happen. There was a reason 20, 30 years ago when labor costs were, say, 60% of a product.
Right.
And, cost of labor was, say, 1/10 the price. You could almost save half the price of something. It was a slam dunk. Today, because of automation overseas and here and everywhere, labor costs are maybe 20%. But labor price differentials are probably half.
Mm-hmm.
So now you're only saving 10%, not 15%, but you have shipping and you have tariffs and you have national security.
Right.
It's crazy we don't make all our drugs here. It's crazy that, we have an, adversarial countries making things that are critical for American. I don't think that changes. And honestly, I'm not trying to make this controversial, but this is my personal assessment. I think that Trump took these foreign policy objectives from Democrats. So I actually think his view on trade and manufacturing is a Democrat centrist policy. And as he did that, the Democrats really, other than saying we want to do something different than Trump, really couldn't do anything different. So it's like, as much as Biden wanted to reverse everything, he kept tariffs on China. He kept, there were, right? He said we need energy here. So let's go and spend $5 trillion on energy. I think there's actually from these dynamics, both energy and manufacturing, these are bipartisan policies. I don't think there's a lot of difference.
Right. I think the difference is
as a venture
about
firm,
it and being about it.
As a venture firm, we invest over 10+ year cycles.
Yep.
So, we have to assume there's a couple of recessions, a couple of administrations.
Yep.
A lot of things change.
Right.
But I think the secular drivers here are so powerful and so important that I don't think anyone would say, no, you know what, we'll let India and China make all of our, essential cancer drugs. Like, I just don't think, I think people wake up, I think people have woken up and they're just like, we have to change that.
Right. Yeah.
And so I think that's going to happen. And with the automation that's happening, which is disruptive, a lot of people are going to say, where are the real opportunities? And I think a lot of entrepreneurs will come out of the woodwork and start businesses to do different pieces of this.
Mm-hmm.
That if you look back 10 years from now, you go, my God, we built an incredible supply chain.
I agree. How do you look at, I remember reading about this scenario where a lot of times the company that brings the new idea and is the first to market with an idea is very rarely the successful company that takes it, worldwide or really makes a thing out of it. So I would imagine that a lot of the companies that you look at to work with have pretty original ideas and are creating something that really hasn't been created before. I don't know if that's true or not.
No, that's fair.
It is fair. Okay. So would your argument be that the capital injection and the method by which you grow that company is all that makes the difference, whether they're the big player in the end or not?
I think in some industries, being first can be helpful. Capital can definitely be a differentiator. But most industries are not winner take all.
Right.
Search is kind of winner take all. Most people don't use Ask Jeeves anymore.
Right.
Yahoo apparently is still around. Alta Vista, which I think was the first, we tend not to use.
Right.
Right? Instant messaging. There was AOL Instant Message, right? And where's that? So, some of these are very dominant winner take all, 2-3 winners, but most industries are not like that.
Right.
And when you have a massive industry, there can be real opportunity for multiple players.
Right. Yeah, that makes sense.
It's about your own execution more than, are you going to be outcompeted for most industries?
Right. Okay. So when you get involved with a company that you really believe in, where does that initial, because these are, you already said that they're kind of not capital intensive, or at least relatively not capital intensive business models. Where do you typically put the first investment dollars? What is the most important thing to get these companies to the next level?
We are great believers that we invest in businesses that use technology, not technology that can become part of a business. So the companies we back happen to use technology, but only because that technology enables them to do something 1/10 the price or 10 times better than the alternative.
Okay.
As opposed to AI is important, so we're investing in a bunch of AI companies. That's not how we look at it. So I'll give you an example. We invested in a legal tech company called Alexi. But, they're based up in Toronto, growing, double digits month over month. And they help lawyers do lawyer stuff happens to use AI.
Yep.
And it is, fits into that aspect of being 10 times better product and 1/10 the price of having a bunch of lawyers do that research, pull that report together, do that analysis,
Right.
etc.
Right.
Great company. Now, when we first invested, the company was very focused on the science. They had actually, a number of years ago, built their own GPT technology. They kind of decided about a year ago, the fact we built our tech, why don't we just leverage the investment of, folks like ChatGPT, and then put our proprietary layer to the side of it and on top of it, but leverage those aspects because they've commoditized it rather than us. And the company's just really taken off.
Right.
CEO is very sales driven, and they're crushing it. But where they started and this was before ChatGPT came out, they started saying that this, general purpose transformer approach is the right approach. And then as the dynamics around them changed, they said, where's the value add we bring? Is it building our own fundamental models, or is it our interpretation that sits on top of the models? And they decide the latter. So, for us, early revenue, engagement with customers, finding out what they want, where they say, I need more of this, I'll pay for that. I don't care about that. I won't pay for that, is important.
Yep.
Not running a science experiment and then getting to revenues in 4 years.
Right. So customer engagement.
Very important.
Very important. So what mechanism do you use to do that? Is that, okay, we've sold 10,000 units, let's talk to those people? Or do you have some way to survey people who aren't customers and find out what features and benefits they would like out of the product? Like, how do you go about that?
Well, invariably, you want the CEO to be the salesperson in chief. You want the CEO in every sales call, listening to the customers, interpreting it, coming back and saying to his product team, you need to do this. Coming back and saying to his engineering team, you need to do that. Coming back to his sales team, marketing team, say, this is how we need to market. You need very closed loop development of how the product needs to be adjusted to get to, product market fit, which is a term in the industry.
Right. Have you seen any consistencies or patterns in marketing, let's say, a robotics automation sort of product, in what works and what doesn't?
So, what's interesting in the hardware companies that have deep software layers, which nature of the kind of things we do, is, are they making money by selling hardware that happens to have software embedded?
Okay.
Or are they making money by selling software that happens to have hardware embedded?
Right.
So what's the monetization model? What's the business model? How do you get paid? How much is upfront? How much is recovered over time? What are the term of the contracts? How does all of that fit together?
Yep.
And in some industries, initially people just want to buy the hardware and run with it. In reality, that kind of doesn't work. And we're starting to see this even, I'll come back to Tesla again. You can go and buy a car, and then you can pay money to subscribe for things you want, like full self-drive, pay $100 a month.
Okay.
You can pay a certain amount a month to be able to watch Netflix in your car.
Yep.
To enable that kind of dynamic. So, even in a hardware-intensive business like selling a car, there's a sense that there's some kind of subscription you can embed in it.
Right.
Even more so when you're selling capability into industry. Robots who can do certain things, certain capabilities. If you're going to, buy a robot and the software is going to be continuously updated, shouldn't you be paying so much per month to get access to that continuous update?
Right.
Or do you want to stay with the same, in 3 years, have the same product with the same capabilities you bought 3 years ago, but your competitors are paying the $100 a month or whatever it is?
Right. Right.
And theirs are twice as capable, more efficient.
Right.
So it really depends on the business model. We generally prefer ones which are,
Sort of
software-based models with, enabled by hardware.
Right. Okay. Yeah, in kind of what I was hearing too is sort of like a modular scenario where you can pay for extra value add.
Right. And one that the extra value add might be additional capability, or it might be to access all the updates. Because, if a company is a good company, they will find ways to make that hardware smarter over time.
Yep. Yep. Okay. So I think a lot of what we just said sort of answers part of this question, but you may have something additional. So if you are an early stage company, maybe you're a sole founder right now, maybe you have a couple team members that you're working with, on the engineering or development side, and you want to attract venture capital, what would be your biggest piece of advice for that person?
When you're just getting going, you need to be a storyteller.
Yep.
If you can't explain what you're doing in a simple story arc, if you can't have a 15-page deck that walks through it and explains it, if you can't explain as if you explain to a 4-year-old, then you have a problem. I think humans are storytelling, story consuming, pattern matching, evolved animals. I think that's just what we do.
Right.
And, so as a founder, you really need to be a charismatic storyteller, explaining what you're trying to do, why it's going to work. I've used this term probably too often, but successful founders are delusionally optimistic. They believe they can get hundreds, thousands, millions of people to stop doing things one way and start doing them another.
Sure.
Right? And that doesn't mean everyone who's delusionally optimistic is a good founder.
Yeah.
The world's full of a lot of delusional people.
Right.
But you really need that characteristic. You need to be able to say, look, we've done it like this forever, and now we're going to do it like that. And we're going to do it like that now because of this emerging technology. And we think we can build not only a business here, but one with a defensible barrier to entry so that our profits are not competed away over time. And that's what you need to do.
Yeah.
And then you need to find VCs, angels, investors who buy into that vision and understand it.
Yep.
To make it happen.
Yep. So how do you go about, say you've got the characteristics, the storytelling down, you've got the defensible product. How do you find the right VC firm?
Well, it's much easier now than it used to be. You can probably go in and write a prompt for Grok or ChatGPT or Gemini that says, find me VCs who are active today, who invest in this space, who haven't invested in competitors to the following product, and it'll probably spit out a bunch of people.
Yeah.
Yeah. Now, my general belief is, and every VC will tell you this, is warm intros are better than cold intros. We actually are neutral. Somebody comes in that interests us, we will look at it. But I will tell you, almost every company we've ended up investing, ex post, seems to have come from a warm intro.
I see.
So that we don't filter for that. Some VCs do. I remember talking to one VC and he said, I am only going to invest in founders on their second business when their first business exited over 10 million. I go, why? He goes, because statistically, they tend to generate good second businesses, and it keeps my life simple. Do you fit this screen? Yes or no? If you don't fit the screen, sorry, but we're not going to look.
Yeah.
So, everyone has their own process. We don't have that process. But like, and it's the nature of not just that the business being great and everything, fundamentally working, but luck. Do you hit the VC at a time when they're investing, when they haven't invested in competitor, where they didn't have an argument 10 minutes before they came into the meeting or whatever it might be, right? It takes a lot. And I almost have this belief that if the seed round, or what they call today pre-seed round, is too easy, the business is likely to fail.
Mm.
And if it's really hard, the business is likely to succeed. Now, I think
sense.
it's more. It's a decent correlation. I think the fun. If someone comes to me and says, "I'm raising, 2 million on 10," and like, "Oh my god, I'm oversubscribed. I'm going to raise 5 million on 20," and blah blah blah. They'll raise the 5 million, they'll spend it, and now they can't justify. They haven't got the business to the point to justify the next round.
Right. Pretty typical. You didn't earn it. You didn't.
Yeah, yeah. I mean, it's funny. I think there are a lot of lessons embedded in the HBO series Silicon Valley. So if you haven't watched that, I would watch it.
I haven't, but yeah,
Particularly season 3 and 4.
Yeah. Okay. Yeah, I'll check that out. I would definitely will do that. I mean, this is fascinating stuff, and it's complex stuff, and I really appreciate your knowledge. I'd love to continue to pick your brain and hear about some of the boards you've served on and stuff like that. We might have to do a second episode at some point, but a lot of knowledge. Really appreciate the insights that you shared today.
Well, thank you for having me on the show. This went very fast for me, and I hope it's gone fast for listeners as well.